I mean, gold is a sort of asset that normally moves about 10-15% a year, right? This year it's up, what, 50? It's gone a bit nuts. I do think it's overreacted, but you know, it's been a combination of China buying relentlessly. People have been talking about that's the real bid that just doesn't seem to care or what the price is.
Yeah.
It's turned into a momentum trade now as well, right? So all retail have stepped in. So whereas AI stocks were the momentum trade, now it's gold and silver.
So this morning, the investment banks, they're going in reporting all their exposures to the big bosses because of this regional bank turmoil. The small panic in regional banks.
Yeah, so like the regional bank sector in the US was down like 6% in a day, which is quite a chunky move.
Yeah.
And you know, credit concerns coming back and stuff. But the thing is, we've seen so many of these little credit blow-ups now since '08, and the authorities are so fast to plug the holes now. So you know, it's quite hard for it to turn into anything too sinister, I think.
Definitely.
Yeah.
But then you do have stocks such as Barclays up 33% this year. Standard Chartered up 40%, BNP up 20%. So they have had big moves, albeit they've got perfect conditions with interest rates.
Yeah, and the big banks are somewhat insulated, right? It's really the regional banks which you're a bit more concerned about.
Yeah.
That they've got skeletons in their closet kind of thing. But you know, the too big to fail type banks, I think, are fine, right? Like the big US banks did well as well in earnings last week.
Although Jamie Dimon clearly peeved that he ended up taking $150 million hit in one of these things, you know. But yeah, so we've seen this before. We've both experienced it. It doesn't feel like there's a subprime-esque problem, but that's not necessarily going to be needed just to take the S&P. You know, are you surprised the S&P is as high as it is?
I mean, you know, when you're driven by rates and liquidity, like we have been for so long, you know, we are cutting rates at a time where inflation is not low, right? So it's kind of, they're just running it hot and asset prices are reacting basically, right? So, you know, I think I would be more surprised probably to see 6,000 on the S&P than I would to see 7,000 by the end of the year, right? Because we are in that world, right? Like they are, you know, they should be probably more prudent about inflation, but they don't seem to care that much because there's so much pressure coming from Trump to bring rates down. He's bringing all his people into the Fed as well, right? And now you had Powell, right, talking about it last week about balance sheet, slowing the pace of balance sheet reduction, which was effectively dovish, right?
Well, I assume that's because they'd already told him.
Yeah.
The regional banks had already had to tell the Fed what they were about to announce.
Yeah. But again, that's a dovish comment, right? So it's kind of, whilst rates and liquidity are supportive of the market, it's hard for the bears.
Yeah.
Very hard for the bears. That's not to say you won't get these little corrections, but they're just flash in the pan type moves that literally, like, they last a couple of days. And if you don't monetize all your protection, it's gone, right?
But that can be very, it pays off well, doesn't it? The chance to monetize that because we're at the levels that we're at, because vol was so low, you can get a bit of an explosion.
Oh, for sure. I mean, when volatility gets cheap, and options give you great leverage, right? And when you time it well, I mean, we had a 3% down day, which we hadn't seen in how many months, right?
Yeah.
So it's the biggest drop on the S&P on that Friday when Trump came in with his tariffs again, right? Finally, the market cared again, and the leverage you got on any S&P protection was amazing, but you like 2 days later, the market was back at 6,700, right? So
it's crushed again. Yeah.
So it's kind of, you've got to be pretty fast to trade that, and the market's kind of figured that out as well, which is why the vol is quite high, right? It does pop a lot. VIX got to 29 last week.
Explain to people what the vol is.
Just how much volatility itself moves, basically, right?
Yeah.
So if you look at, there's a measure called the VVIX. So everyone knows what the VIX is, right? Which is the S&P volatility, effectively, right? And that got as high as 29 last week on this regional bank wobble. But by Friday, it was back to 20 pretty much, which is a pretty big swing from 29 back to 20.
Yeah.
But the thing that kind of reflects that volatility of volatility is the VVIX. and the VVIX is like up at something like 120, which is pretty high, right?
Wow.
So it gets maybe as low as 80, the VVIX,
Okay.
but right now it's about 120, which is pretty pumped.
I was warned off. Actually, probably when you were still at Credit Suisse, I was warned off trading vol. Like that was, that was the sort of widowmaker,
Well, I think the widowmaker is being short a load of vol, right?
Yeah.
Because the amount you can blow up on that is quite spectacular, right? So like selling calls on VIX, for example, right?
Yeah.
As a retail trader, you'll look at calls on VIX and think they're super expensive, right? But that is how you blow up your account, basically, right? So there's loads of there's not just retail, there's loads of hedge fund traders over the years who've thought they were smart selling really expensive VIX upside. And yeah, whilst nothing happens, it earns you amazing time decay and it works really well.
Yeah.
But you know what? Once in a blue moon, when it goes, it wipes you out. So it's not something I would ever recommend doing.
Let's have a look at the 6 months then. This is the iShares gold ETF, and you can see there right from the Fed indicating that rate cuts were coming back in August. Then that's been it. So the Jackson Hole that sent us into overdrive. But nobody expected that.
Parabola.
Yeah.
Yeah, it is quite crazy just how steep that is. But if you've been long it, congratulations. But I think you'd be mad not to be putting some hedges in place now, right? Because like how you probably didn't allocate whatever percentage of your portfolio into gold thinking it's going to be up 50% this year.
Exactly.
So you kind of need to just be a bit like prudent and say, I've made way more than I would normally make on this allocation. I either need to dial it down a bit or I need to put some hedges around it, right? You might not want to sell it because you're like, why am I going to sell this? It's working, but it's hard to not think there's going to be some kind of pullback in the next couple of months, given how overbought it is, right? Yeah. So what you can do is you can sell upside calls, maybe 4,800 calls or something, and you can buy a put with the same premium that you receive.
Let's look at the IG option stream on gold then. So how far out would you go then?
Probably 2 months, right? So December.
Okay, so
I mean, that one actually expires 24th of November. That's only a month, right?
Yeah.
So maybe go a bit further out just to get a bit more juice out of those calls.
Okay.
And then where are we trading? We're trading, I don't know where the future is for that particular expiry.
It is 4312.
That's where the future is, yeah?
Yeah.
Okay. So then, push it a bit further out. So what do you get for that 4,800 call?
65.
Yeah, so you're getting about 1.5%-ish for that, okay?
Okay.
Right? And then what put can you buy for that same premium?
You can buy a 3950, 3,950.
And see where the vol is on that. The vol's 20...
22 and a half?
And what's the vol on the call?
24.8.
Exactly. So in gold, you have upside skew, right? Which you don't have in equities, right? In equities, you always have downside skew. So the put vol's higher than the call vol. And so when you need to hedge your equity exposure, you're kind of paying up for that a little bit, right? The beauty about hedging your gold exposure is you're not paying up. They're giving you some edge because they're paying up for those upsides because of that explosiveness that it can have on the upside. But once the move's already happened, you're kind of like, you're getting a really decent benefit for that, right? So that's a nice way to protect the exposure, basically. Now, you could do a bit more funky stuff that, like put spread collars where you don't buy a put, but you buy a put spread instead.
Okay. So take us a bit closer to the money on the downside.
Exactly. So instead of buying that 39.50 for 60 ticks, maybe you buy the 4,200, right, for 150, and then you sell something lower down. Maybe you sell the 4,000 against it. So that's only costing you 75, right?
Yeah.
So you're so it's pretty much spending close to zero, and you've got protection down to 4,000 out to Jan, right? And if nothing happens, you didn't really spend anything, right? If the market keeps rallying, you've made peace with the idea that you're going to get taken out of some exposure at 4,800, which is another 10 plus 12% away, right? And then you're looking at a 62% return on the year, assuming we're up 50 already. And if you get the pullback, then you can monetize your protection. So you don't have to sit there and wait till expiry. Once this thing gives you some money because you get a pullback, you can just unwind it and take whatever you made, basically.
And that's literally about a 7% pullback, which is exactly what we're we're talking about. You know, it would it would make sense. I don't think anybody would be surprised if gold was down 7% over 3 days in the coming weeks.
Yeah, and the beauty of a put spread collar structure, that's what that's called, is that it's a short vol structure, right?
Yeah.
So if vol goes lower, because vol has doubled in this move, right? Vol's gone from like 15 to 30 pretty much. So if vol pulls back to 25, you actually benefit because the price of this structure will go up, right? Yeah.
Awesome. So that's on gold. What else are you looking at the moment that's jumping out to you on the option side?
What have I got on right now? I mean, apart from I've been hedging a bit of my semi exposure. So I've got positions in Intel and Taiwan Semi and stuff like that. So
Intel reporting this week as well.
Yeah, so I've been doing some risk reversals on those as well. And then just in terms of
so let's look into Intel there, because it is one that we look at quite often on the show. Mm-hmm. So there is the daily, and of course this is really interesting vol-wise because it had the big drop last year, and of course now we've seen everybody and their uncle taking a potential stake in the company.
Yeah, exactly.
So they've got no liquidity issues anymore. So what do you do if you see it up at 37?
Well, I mean, I was buying it when it started to try and break that range to the top side at like 20, what's that level?
26 to 28?
Yeah, so I was buying it around 26, 27, right? And it was like so many false breaks, but I held on to it because I didn't buy options, I just bought Delta One, right? Just shares. Now that it's popped this much, I'm kind of like, okay, I don't really want to sell my shares, but again, I'll do the same thing, I'll protect them. So I think I bought like the 33 put and financed it with some 45 call or something like that, basically.
Right, okay.
Yeah, so I've got that to November expiry. So if it does have a pullback over earnings, then great. If it takes me out at 45, don't really care because I bought it at 27.
That's the last thing you care about.
You know what I mean? If you bought it at 27 and it takes you out at 45, I think you'll take it, right? So that's quite a nice trade. But it's like the onshoring trade, isn't it? It's like Trump wants to onshore manufacturing of semis.
Yeah.
And so they're going to be supported by the government in some way, shape or form, right? So you probably would buy pullbacks, but I just think buying it up here, I probably wouldn't chase it up here.
And what about TSMC then? Are you thinking more that they suffer from?
Maybe. I mean, I think you saw the price action after earnings last week, right? They had record earnings again, and it kind of opened up and only traded down from there, right?
Yeah.
So when you see bad price action on good news, it makes you wonder, is this thing a bit toppy now, right?
It's certainly, I mean it.
Yeah, I mean, I think I've had it for like 200% basically on my shares on that thing, right? So it's kind of like, again, I don't want to sell something that's up 200% because it's like a long-term hold and a theme that's been in the book.
Yeah.
But at some point you got to say, okay, price action stinks on earnings. Let me put a hedge in place. So I've got December risk reversal on that one in case this thing wants to roll over a bit.
And risk reversal
is that still call buy put? Exactly. Yeah. So those are the hedges that I've got in place. And then in terms of longs that I kind of have put on using options recently, like the delta trades that I was talking about, I've got some longs in the cannabis sector.
Oh, right. Oh,
Yeah.
that's a new one for us. I don't think we've ever covered the
because it looks like the Trump administration's going kind of hell for leather on trying to push that and like deregulate that basically. And it's actually been in a long-term downtrend, but it's showing signs of an uptick, right?
And then, so this is just an index that IG put together.
Oh, okay.
So the cannabis index.
Yeah.
But do you go single stocks or do you go on any?
No, I just stick with the ETFs. I did some ETF call options, sort of medium-term ones, right? And the solar sector as well is quite interesting.
Right.
Because the idea, and these are longer-term trades, so they might take months, if not years, to play out, right? So you kind of don't want to go too short-dated with those options, right?
Okay.
But if you zoom out a bit, so you can see a much longer-term chart, that's been even longer, right? How far back is
Way
that go?
back. Well,
okay, that's pretty good. Yeah.
Go to weekly.
Yeah. So the idea here is that this sector, that's First Solar. I've gone for the ETF.
Ah, right. That's why it looks different. Right.
Over the TAN ETF, yeah. But the idea just being that all of this AI energy
Tan as
demand.
in get a suntan.
Yeah, exactly. Yeah.
It's brilliant. These are genius. I wish my job was coming up with ETF names.
I do love some of those names. They are hilarious.
Yeah.
But the idea being, if this AI revolution or whatever you want to call it needs a ridiculous amount of power to drive it, right?
Yeah.
And China have been dedicating a lot towards building out their solar energy, right? So everyone's kind of going to follow suit, right?
Yeah.
To build that out. So, because everyone's going crazy for nuclear, but how long does it take to get a nuclear reactor online, right?
3 years at least.
10 years probably, right?
I think, well, the mini ones.
Oh, maybe the mini ones, yeah. But that's the point. So there's going to be a need for more solar in the energy mix.
Yeah.
And so, Trump, when he first got in, he was like anti-alternatives, right? Anti-renewables. But there'll be a point where there's this big U-turn on solar because they'll realize that they have to have a lot of solar in the mix, basically.
Yeah.
Right.
So this it's just starting to show some life, isn't it? After
Exactly. Yeah.
sort of a few months of not doing much. Okay.
So for the longer term call options, you want to look for things that have been in the doldrums for a long time, but are now starting to come alive, right? They're starting to turn. The vol's not crazy expensive, right? On the cannabis sector, vol's expensive because that thing can do 20% in a day easily on a piece of news. But in the solar sector, vol's in the 30s, right?
Okay.
So that's really quite cheap if you think of it on a long-term basis. If you think the sector could 3 to 5x over the next year or 2 years or something,
Wow.
then a 30 volt doesn't feel too bad, right?